Hi guys, I thought I'd do an important topic today that get asked a lot about is inheritance tax for UK expats. This is particularly applicable if you're over the nil rate band or you've got a foreign spouse as well, so it doesn't double up. Get asked a lot is how can I mitigate this without getting into too much bother? So I'll go over a bit of the ways of what is meant by domicile, what's included in the IHT plan, what are the current gifting rules, and some of the trusts and options you can do to mitigate that as an expat as well. So if you're domiciled, it's basically giving up your deemed domicile is one way of getting out of the UK inheritance tax. Although in theory, this is quite tricky. We've done it with one client recently, and it includes his accountant having his will kind of redone so his ashes aren't put in Thailand. As a given example there, that even if you've got a plot in the UK, it can be classed as deemed domicile. So this is quite a tricky path, and if you want to do it, you've got to make sure you've got to do it with HMRC properly and confirm it with your lawyer and any other parties involved in this as well. So changing domicile or getting rid of your domicile, means having everything outside of the UK, bank accounts, pensions, property, and just cutting all ties with the UK. This is an option for people that have left the UK for 30, 40 plus years, have no ties with it, and therefore don't want to have that, may also have a second citizenship as well. So the inheritance tax rates, this is why it's quite applicable and it comes into factors for a lot of expats, is it's quite low, especially if you've got property. If you've got property, it's 325 as the base rate without a prime UK residence. Property, as you can see, this is for a single filer, doubles up if you've got a UK deemed domicile spouse, but it's quite low. If you've got a property, say, for example, in London, you're automatically going to be over that, and you're not living in it, so you're living abroad, you're automatically going to be over that rate. What it's done is it's also done on your worldwide assets, so anything is taxed on 40% of your worldwide assets. Transferring between spouses, we touched upon here, different nationalities. If you want to kind of double up your tax band or get to that rate, your partner or spouse will have to be UK deemed domiciled, and this can be done through various ways. Normally it involves living in the UK, so it's maybe something that you can plan towards on that. So ways to reduce your inheritance tax and liabilities: putting in a trust, gifting it in your lifestyle. You can have QNUPs as well. There's also more obscure ones. If you're kind of ultra wealthy, you've got farmland, AIM shares. For example, what you've seen in James Dyson is buying up farmland at premium prices just to mitigate the inheritance tax on that. But it's more an obscure way is farmland. AIM shares is one, particularly, it's still a bit risky if you're looking at AIM shares. They have had some bigger listings in recent years go into the AIM, but still it's a smaller company on that. So looking more if you've got significant amounts, but the gifting or the trust option. So this is the gift rate. You have the 7-year gift allowance, as you can see there. It goes down in kind of 8% from 3 to 7 years. Also, you can give up to £3,000 a year tax-free, or £250 per person. So if you've got a vast amount of friends, you can use that. Again, if you've got substantial amounts, it's really not going to have too much of a difference on these £3,000 gift allowance a year or the £250,000 a year. Obviously, the potential for gifting during your lifetime, this is a kind of risky game because you've got to do it in the kind of 3 to 7 year period. May want to do it earlier. This is one plan that you can do. Discounted gift trusts is another option. With that, just a quick note as well is that you can gift unlimited amounts to your spouse if they're if they're UK citizen or deemed domiciled. This is completely tax-free, and then it doubles up and goes down to the next in kin, whether that be the eldest child or whoever it is after that. Writing a will, again, this is, as we spoke about before, having a will in place where it cements what's there, particularly if you're kind of declaring yourself non-deemed domiciled, having little things which touched on before is getting it, making sure your ashes are spread outside of the UK and getting that done. It's a little loophole that HMRC like to get. Another way to mitigate it is life insurance to particularly cover the cost of it, but I'd say, look, better to plan properly. For expats, one of the main one is a QNUPS, is what you can do, or a discounted gift trust is some of the trust. If you are looking to do it, it can be quite a complex procedure if you've got a foreign spouse, and it does take proper planning. Feel free to get in touch at info@investmentforexpats.com.